And hello, everyone. Welcome to Options Talk, a live market session with the Option Professor. It is October 19th, 12 p.m. Eastern Time. And what a better day to find than a meeting on the weekend and planning for the week ahead. And we are super excited that the option professor, of course, will be here with us today. And as usual, with his very unique ways on or views on the market. My name is Daniel, and I will be your moderator today. And a quick reminder that this session, of course, will be recorded, and the recording will be sent to you shortly after this webinar. And I also need to remind you that trading does contain substantial risks and therefore is not suited for every investor. If you trade, make sure to only use risk capital, which is capital that you actually can afford to lose. When it comes to backtest performance or hypothetical performance, keep in mind that this is not necessarily indicative of future performance, and any trade ideas and strategies discussed in this webinar should not be construed as trade advice. These are for informational purposes only. All right, so with this out of the way, let me quickly introduce ourselves. So if you're joining us for the very first time, we are tradingindicators.com. I am a managing partner of Trading Indicators. I'm the guy here on the left-hand side. My name is Daniel Sinek. I have created this business together with Homer, my business partner, around 10 years ago. Homer and I, we go back 20 years ago. We met back in the day in grad school where we were stuck in the same research lab, a lab without any windows. She was doing her PhD at the time. I was doing my master's. And I guess that was a very bonding experience. And ever since, we've been working on business ideas together. We also have Nicholas as part of our team. And if you know us, then you may also know that most of our recent trading indicators, which is our core business, have been built by Nicholas. Over the years, we've built hundreds of indicators for clients all over the world. Most of them are rooted in technical analysis. We believe that trading should be simple, and in fact, trading is simple, but you need to know what to look for. And especially for today's webinar, we are going to share with you what we, and more precisely, what the option professor is looking for in today's markets. Talking about the options professor, we have, of course, Jim Kenny with us today. And Jim, let me ask you, are you there?
Yes, can you hear me?
Yes. Hi, Jim. How's it
Hi, how are
going?
you?
Maybe say a few words about who you are and yeah, your experience when it comes to options trading.
Sure. I've made a career of the options market, so I've seen the entire development of the market from when S&P 100 was the big thing to where it is today, where many people didn't do options at all, to where 80%, they say 80% of the retail customers are involved with options. So it's been a very long journey. I started out at Boston College, and then basically I went to some of the biggest brokerage firms. I went to the advanced options training at the Chicago Board of Options Exchange, that's called the Options Institute. And of course, they sent me over there to make sure I had my knowledge and my experience and my expertise before, obviously, I was going to work with a bunch of people. So I had a very large career there, and I did seminars for decades and decades and decades. So I'm very familiar with explaining options to all different skill levels. And one of the things I get a big kick out of is trying to help people reach their potential as an option trader. And I think I can very much do that because that's what I've done for my whole career. So basically, that's a little background on myself. And I'm very excited today because believe me, if you're not excited about the environment we're in now, you got to check your pulse because this is a very exciting time.
Awesome. Thank you, Jim. Yeah, we're going to get to the environment, the market environments in just a second, but here is what we have in store for you today. So we're going to start off with a market review, and this is when Jim will talk about the current market environment and what potentially to expect moving forward. Then we're going to move over and say, or explain why you may want to consider using options to trade today's markets. We have a very special offer for you in store, so please stick around for this. And towards the end, we are going to share with you or explain to you two options strategies, which may allow you to grow a small amount into a big amount. And of course, there will be plenty of time for Q&A throughout. Talking about Q&A, if you have any questions, don't wait till the very end. Please put them into the Q&A box of your Zoom window. I'm going to keep an eye on those questions and I will bring them to Jim's attention as I see fit. And of course, the more, the merrier. All right. So without further ado, Jim, let me ask you a question. So everything seems so bullish. All the index futures are up, bullish, bullish, bullish. Do you see blue skies ahead, or what is your take on the market?
Well, I think the market right now is obviously you don't step in front of a freight train. So Julian Robertson, a very big hedge guy from Tiger Financial, used to say, bad mouthing Netflix is like bad mouthing Santa Claus. This market has been delivering gifts to us and gifts to us ever since October of 2022. In fact, we are having a happy anniversary this week with the 2-year anniversary of the bull market. Now, that's the good news. And then, of course, the world will always be changing. So the history of the bull markets, there's been 11 of them since the World War II, I guess, or 1947, something like that. And out of the 11 bull markets, after 2 years, every single one of them had a 5% correction the next year. And there have been 5 of them that had corrections of 10% or greater, but not up to 20% correction. And then they've had 3 of them where the correction actually turned into a bear market. So in percentage terms, about 75% of the time, you're either going to get a 10% or better correction, or you're going to turn into a bear market. Now, history is history and now is now. So, obviously history doesn't have to repeat. But that kind of statistic, and when we're up this high on the market, you would have to be silly not to give some, eyeball to that. But you don't do anything unless the trend is telling you that it's going in that direction. And so that's why I have an eye on that. I'm not going to be caught sleeping, but I'm not going to be the person who starts the downtrend. I'll let the thing turn over. I have plenty of great indicators that'll tell me it's turning over. And when it does start turning over, then obviously I will be changing my tune and making sure I'm working in that direction. Of course, this is also why we do the strangles, which we're going to talk about at the end of a little later in the broadcast. We want to be in calls and puts at the same time, because you could wake up any day and have a big correction because of how extended we are. But likewise, we could go up to 6,200 on some kind of a panic buying. So the market can be very binary up here. Certainly there's no evidence of a turnaround, but there is some indicators of momentum slowing a little bit. As you can see with the tech sectors, doesn't have quite the legs it used to have. It is gaining legs now, but again, things can change in that sector pretty quick. If you've been around the markets long enough, semiconductors are a volatile sector both ways. So what's my view? My view is it's blue skies right now. But if you tell me that next year could have a significant correction, I would nod my head as a very real possibility.
Awesome. Thanks, Jim. Great commentary. And perhaps go ahead and share some of your slides or some of your charts and walk us through some of the markets as you see them right now.
Yeah. Tell me how we're doing.
1 second. Give me 1 second. I have to stop my sharing first. And there we go. We can now see your slides. Perfect. Go ahead.
Okay, so anyway, I'm going to give you what they call the cliff notes of around the world, because there's a lot of things going on, and I as an investor have many things going on, and I'm sure many of you do as well. So I'm going to give you a quick rundown of a couple of ways things are looking. Right now, we've got the S&P, as you can see on the 20-year graph. That's a very extended number. And why has it gone up so much? There's 3 things to keep this thing going. One is consumer spending. Everyone's working. Everyone's got wages higher than inflation, and retail sales are still jumping, and the restaurants are still full. So the consumer's still out there spending. And he might continue spending because the credit cards that he's run up, he's now going over to the refi market on his real estate, and he's getting loans against his real estate to either bring that to pay off those credit cards, or maybe to spend more. So that's the next avenue where people are trying to get money. The second thing is earnings. I mean, these people are earning money, right? So, and we're going to get we got 10 days between now and 10 days, and we're going to get all the big guys telling us if they're making a lot of money and how things are going. Obviously, Netflix is making a lot of money. You saw what happened there. So that's going to be the thing, and the earnings are coming in. But we also have a valuation expansion. How much will you pay for $1 of earnings? Right now, on current earnings, it's 25 PE ratio. By any measure, that's excessive. But they're expecting earnings to be jumping in the fourth quarter and next year through the middle of the year about 18%. So that would bring the PE ratio down towards 20, 21, 22. Still very high, still very high. Cannot afford any bumps in the road with this kind of PE ratio. But again, the earnings are coming in supporting things, and that's why the thing keeps going. So that's your trifecta. You've got the consumer spending money, you have got the earnings coming in, and you've got high valuations. And again, you know, if Trump were to get in there, I would imagine he'd put some pressure to get these rates even lower and lower. And the markets are starting to discount a possible victory from him because I'll show you some evidence of that. The financial stocks, this is the XLF. Would be good for banks. You know, obviously get a lot of action with real estate, and real estate loans would be good for banks, right? Well, there you go. That's breaking out to all-time highs, right? Then commercial real estate, right? So here's a stock that doesn't come now. Commercial was left for dead, wasn't it? No one's going to work in the office. It's going to go out of business. There's going to be, you know, and look at this. This is Simon Properties. That's not going out of business. That's breaking out to new highs. So that's another Trump tip or tell. Another one would be Bitcoin. And on Bitcoin, I've been telling people once it starts getting sustained above 65,000, it has the potential of flying. And so here you'll see Bitcoin did get above the 65,000 number, and Bitcoin did break out from the 63. Actually, it was 63. I was telling people. You see it right there, and bam. So that's starting to go. So that's all little tips that they are counting on Trump to secure the victory in well, 2 weeks, something like that. Okay, so that's the stock market story. Again, still looks great, but you have to be concerned about a correction coming at some point in time because it always reverts to the mean at some point. Now, the first indicator that it might be reverting to the mean, it has to stop making all-time highs, and that's a tough racket because you know the earliest this thing could show you any signal that it might be out of gas would be the end of November. Okay, one thing that has definitely happened is the tech sector still is lagging a little bit. Now it's caught up. It's caught up. It didn't have a very good look. It didn't have a very good July through September. Right? But since September, it has made its way back up. That's the all-time high on QQQ. It certainly looks like it wants to take it out. So basically, you know, the tech sector definitely lagged value and dividends for the summertime, but it has played catch up now. And the RSI right here, if it starts breaking up, obviously would be very, very, very good. So I'd monitor this, see if it can take this out and get going. It does look like it wants to. And then the small caps. Everybody loves the small caps. Well, let's see how much you should love them because they are spotty. They go up, they come down, they go up, they come down. So obviously this is a big beneficiary of the lower rates because these are the guys who borrow money because some of these companies are not even profitable. So that's why they're very volatile. And as you can see, you know, it looks like it wants to take off. If it gets above this 230 number, you know, it could accelerate to the upside. So again, and you know where your support is right there at 210. So it's not too bad. So there you go on the stock market in the U.S. Now I'm just going to go quickly around the world very fast. We're going to have the Europe market. And again, Germany's having a tough time. And they believe it's kind of in recession. The ECB is cutting rates to try to stimulate things. Again, it looks pretty good here. Again, as long as it can stay above that number. So the trend is still for better prices in Europe as long as we don't break underneath there. If you go over to China, and that's been my forte because I was in there with the Chinese ideas before it moved. One of the reasons, I'll be honest, and I put it right in the alert that I sent out, is that I noticed on the 13F filing that David Tepper had a big position. He owns the Carolina Panthers, and he's a famous investor. and also Michael Burry from The Big Short. He had big positions in China and Baba. So I said to myself, this is something I want to get involved in. So these options, when they were down here, were dirt cheap. I mean, the $26 call, the strangle was 115 bucks. A 6-month option was 200 bucks at the 26 strike. And you can just imagine right there, you don't have to imagine, 26 minus 37, they went up to 1,100 bucks. Now, when it went up here, I told everybody, these guys are having problems processing their trades. That means it's short covering volume that is overwhelming them. And short covering does end. So once we went up into this neighborhood here, obviously I was looking for it to pull back down, which is what it's done. But I do think on a long-term basis here, there is a possibility that there is a trend here, but it's not going to be smooth sailing all the time. You're going to have to buy the dips and then hold, buy the dips and hold. And that's basically how I'm going to be trying to play it myself. But this is a classic example of you get a pop-up on your options, you grab the money. You grab the money because you have a time clock on you. You know, expiration's coming. You don't have time for dilly-dally. I'll give you an example of why you grab the money real quick, because I think this is a good thing to bring up at this point to show you the converse of not doing it. And this is called Tesla. Okay, now Tesla was humming along very nicely there. Let's get the 1-month graph up for you. So look, it's humming along nicely. All the people with the calls are doing very great, but you know, maybe they thought they wanted to give it another week. Well, that other week, once it comes down like this, you can say bye-bye to all your profits on those short-term calls. So I'm a big proponent of grabbing the money and run, and then look for another setup where the odds are in your favor. That's, I think, the game we're playing here. Okay, so basically that is the China deal, and that gives you a little bit of the international picture. Emerging markets look great as long as the dollar drops. So let's take a look at the US dollar real quick, and I'll give you an idea of what's happening there, because that's really on an edge. Oh boy, is this dollar going to do one thing or the other? Let me show you. And this is this is when the charts are very exciting, because I'll look at the 5-year graph here, or is it 20-year graph? Yeah, look at the 20-year graph. So this is making, this has got to make a decision, right? Because this is either going to get lower interest rates in the US and the dollar will probably lose value, or they're going to delay cutting because of the inflationary numbers and the retail sales, and everyone's out there spending like crazy, and the refis on the housing. So maybe they won't have the ability to drop rates, or at least cut them as much as people think. And that could send the dollar above 105 and get going again. So it's going to be a very exciting time for the dollar. It'll be binary, meaning up or down sharply, and it's probably dependent upon what we do with the interest rates. The price of oil is also something I've been quite good at as far as following the trends. And I'll show you why. Now, oil's got a lot of oil coming on the market on December 1st, because that's what these guys in OPEC are going to be doing. And with the economy in Europe slowing down, and China is a 40% of the demand for oil. Now, you know, that short covering rally, you know, that showed you that it's not following through very well, because their stimulus is a little bit questionable. They're not very clear on exactly what they're going to do. Plus, how do you fix a real estate market where everyone's losing all their money, and there's cities that haven't even been, that have no people living in it, and there's people who bought all these condos on the come line that haven't been built, and they're losing their money too. It's a big problem. And again, you heard that long and variable lags. Well, that's true on everything. Like when we do the stimulus, you'll get a big rally, short covering and spec buying. But again, once they find out it takes time to turn the boat around, then of course reality comes in. And so the demand for crude out of China may not be as robust as they need. So that's the problem here right now in crude. If you look at the prices, here's how I'm calling it. This is on the ledge here. You know, this is ready to either go into the abyss here and have a very surprising drop, or if it ever gets above 80, then I think it would fly, and all the oil stocks, which are very low right now, they could really be great values. But right now, the biggest danger is it goes into the abyss. Now, again, that's why we like strangles, okay? Because why? If I buy a call and a put at a reasonable price for a reasonable amount of time, and I get some news that's going to send the thing way down, well, the puts are going to scream, right? And then, again, dead in the water, of course, is the risk. If you don't get volatility, that's how you lose on the strangles. But again, In this case here, a lot of people are bullish on oil, and if it really tanks, they're going to be very surprised. We'll be a little bit surprised too, but we won't be unhappy because of the put that we'll have going. So there's your crude market, very much on the ledge here going into December. The other thing is metals. Okay, I forgot to tell you that's also a Trump tell that the market is going to go. And let me show you that real quick. And this is on gold. And gold, you'll notice. Well, I'll tell you how I feel about gold. It's very similar to the stock market in, the prices are very extended. Again, when you want to do buying, you'd like to buy them closer to the average. Then you're getting a reasonable price. Up here, you should already be in and just enjoying the ride and trying to figure out where to get off the truck. Now, new highs again. So just like stocks, new highs, you need to stop doing that if it's ever going to turn down. So there's no evidence of a turn down in gold at all. But it is certainly an extended market right now. I've been using the 1 year graph to give me an idea when to get out. So you see the blue line there. Right now, the blue line comes in just right there. Comes right there where that is. So that 2618 area, pretty much 2620, that would be a neighborhood that I'd be concerned if I owned gold if it started getting underneath it. Otherwise, it could go parabolic on you. You don't know. I will tell you one thing though. I did tell people in the last, and by the way, we have exposure in our newsletter or our updates to Goldfield and Newmont Mining and also Freeport-McMoRan. But here's what I did tell people about in the letter, that the silver to gold ratio in Q1 this year favored silver. Now, don't forget, silver can be used in EVs and batteries and in AI. So there's a demand for that stuff. Now, how is it done since I noticed that the gold to silver ratio turned? Well, since the first quarter, silver's up 47% versus gold's 31%. So that was evidence that I was correct on that. Very similar to being correct on the value over tech for the summertime. Now, let me just show you silver, because the guy at the last time we had a meeting, Daniel, I hope you remember that or you don't, he asked me, what do you think of silver? Well, I told him I think it's going to break out to the upside and it might spike up. Well, let me show you why, and I'll show you what it did. Okay, you see all my averages coming in here right there, and that's when he told me. He goes, Jim, what do you think of the gold, silver? I go, in my opinion, I think it's going to spike to the upside because look at it, they're all pointing up and they're all joined together, so it's going to get resolved one way or the other. And in this case, everything's pointing up, so you'd have to bet that it's going to go to the upside. So on a short-term basis, a guy from last week who was talking to me about silver could have picked it up as low as 31.50 and got out of it as high as 34 bucks. That's not bad information. So, and then again, where could it be going if it's going to keep going? Well, if you look at the 20-year graph, you can see it could go anywhere you want because there's nothing stopping it. There's two other things in this area I want to talk about. Platinum. People don't talk about platinum. Well, take a look at platinum. That could be the sleeper here. In fact, I have a guy in the metals industry who brought it to my attention. You see it's right here, and it looks like everything's at a juncture at about 960, 970 bucks. So it's breaking out a little bit there. And so if it gets going, you could see, it go pretty good. If you look at the 5-year graph, you can see there's nothing above it. So this one here looks like it could start screaming. So I just wanted to bring that to your attention. The final thing in this mining stuff is something that is on, we put it in our long-term ideas because, we're going to have strangles we show you, and then we have long-term ideas. So, in the long-term ideas, there's things like Palantir. Well, one of them we had was Cameco. Cameco is one of the world's largest producers of uranium. Now, these data centers, they eat up energy like a dog eats up a meal very, very quickly, right? So they need energy. What are the superscalers doing? The Microsofts, the Amazons, et cetera. They're opening up the nuclear plants, 3 Mile Island. I mean, if you're over a certain age, that sounds like a shocking thing. That was a pretty bad experience, right? Anyway, how do you make nuclear power work? You work with uranium. And you want to know about uranium? These are the guys. So can you see this has been an excellent thing to have, but even better to have on a long-term option and hold on to it, because Lord knows where it could go. Why? Because of the supplies. Production is very slow and it's delayed. And in 2025, they're expecting a deficit of 20 million pounds of uranium. So whatever these guys have are going to come into, there's scarcity, right? So you know how scarcity works in this world. People will pay up for them. That's why they pay $1 zillion for a painting from Picasso. There's not only one of them, right? So again, when you have scarcity, and that's probably why Bitcoin keeps going, when you think about it, because you can print unlimited fiat currency. You can issue bonds until your hands are tired of writing up the contract. But the Bitcoin supposedly has some kind of a finite supply, and that's what I think people like about it as far as the price is concerned. It would make sense that way. So anyway, that's the metal sector. That's some stuff that's going on there. That's what the Bitcoin looks like. And so that gives you an idea. And I gave you a little idea on Europe as well. So that's a
And
quick rundown of the markets. And
Jim,
I
since you
update
add
you every week like this. Yeah,
Jim, real quick, since you added, we got a question coming in, and I
sure.
think it fits in very nicely. What about copper? Any take on this one?
Well, sure. I mean, I'm a big bull on Freeport-McMoRan. I mean, again, Freeport-McMoRan is the Cadillac for copper. Okay. And so basically, if you're going to play copper, you want to play with the Cadillac. And if you go to the long-term chart, obviously this was where we were doing calls on it. We on a long-term, again, we have some long-term ideas where you buy them and you sit on them. Well, down around $41, 41, dollars on this, we had a longer-term position in there. And obviously going up here, and I think we paid like, again, $250 for the darn thing. And when it goes up here, you're making pretty good dough. Now, of course, it comes back to the mean. So as long as we can hold above $45, it still looks like a pretty good deal. And exactly how far it can go, well, if it blows out the 55 number, let's see what the 20-year graph tells you. It's in new high territory. You go into new high territory, you don't know, you don't know how far things are going to go. Look at the stock market. I mean, for God's sake, the old high was 4,800. Everyone said that was a high that would never be seen again, like the South Sea China bubble, right? The Elliott waivers. Well, not only did they blow out the 4,800, we were up at almost 6,000. So again, markets will go wherever they go, and you don't fight the tape, and you don't get locked into an opinion because they say people who live by crystal balls are destined to eat the ground glass when they break. So just go with the flow. But to the point, as long as we can stay above the 45 number, I would continue to be constructive, and really 40. And again, as long as these things are curling up, that's not bad. So again, copper, if you want to play it, in my view, this is the game in town.
Awesome. Thanks, Jim. Let me grab the screen quickly back again. So thank you so much for this market review. I think it was very comprehensive and insightful as always. All
Oh,
right,
can I
so
show you one last thing before you leave? It's
all
on
right, go
Boeing, but
go
there's news on Boeing, and I think
go
people would like
ahead.
to know because I put this in the letter as well. Again, I have a very comprehensive following the market, so if I see something, I say it. So here's the deal: when this stuff was down here at 155 area, I said, listen, there's value down here in Boeing. It's a two-horse race, Airbus and Boeing, and they've got defense contracts coming out their ears. This strike does not last forever. In fact, it ended today. Also, technically, look at the low there, RSI is 31. Look at the low here, 38. That means it's running out of steam and it is out of sellers. And now I would imagine on Monday, there's a potential of a very big spike because of the fact that the strike got settled. So sometimes if you're doing options, you take your shot down here because the options are cheap and you're figuring that the strike will end, and you can see from the momentum that it's running out of selling momentum. And the guys who did that are going to make a lot of money on Monday if this thing spikes up to 160, 170, 180. Okay, that's all I had to say on that.
That's awesome. Actually, this was the perfect segue of what I'm about to say next. So why would you consider option? I think Jim already gave it away just a little bit right now. And let me expand on this just a little bit. And Jim, I'm gonna take this sharing away from you real quick. You can have it back later. There we go. So why options indeed? Well, because with options, it allows you to take a shot at things which you may think has a big potential with limited risk on the table. This is not the case when you trade outright. If you do position trade using stocks outright, there is no limited risk. You have to assume the risk wherever the stock price will go. This is not the case when it comes to options. So the biggest advantage of that is that you have a very clearly defined risk. When you buy an options contract, all what you risk is what you paid for this options contract. You will never lose more than this. So having limited risk is great, but at the same time, especially if you do an outright call, your gains are potentially unlimited. I mean, theoretically at least. So you can still make these big, big gains, yet have limited risk. And this is exactly why options are so interesting. And this is what we are focusing on our options alerts. Now, of course, there are many other things that you can do with options, such as hedging or buying stocks at a discount or generate immediate income. These are more of the more complex things. And in fact, what we spent this summer doing, or what we've done this summer, is we have put together an options masterclass led by the options professor, led by Jim, in which we teach you throughout 6 hours spread over 3 sessions all you need to know when it comes to options trading. So, led by the option professor, and typically this options masterclass, we offer it for $397. It's very comprehensive and very detailed. But today, there's a way where you can get it completely for free. So if you're intrigued by this, stay tuned. We're going to get to this in a second. All right. So with this in mind, let's talk about what we are offering to our users on a weekly basis, which is our options alerts service. We call this the options triple play because each of the alerts that we send out every single month, every single Sunday, directly to your inbox consists of 3 parts. We're covering what we call short-term strangles, which is a particular option strategy, which also what we call a non-directional strategy, where you can profit if the market moves, no matter which direction. As long as it moves, you will profit from these strategies. We'll look at index swing trades. That's a new thing that we have added to our alerts, which basically is exactly what Jim has covered today. It looks at the index markets, the indices, and we give you an outlook as where potential investment opportunities are. And when it comes to these indices, and potentially where your levels are, where you may want to get out. And we also have these longer term plays, which exactly what we've done with Freeport McMoran. I put out a longer trade alert, options alert, which had a bullish outlook on copper, but we let it play out over several months and sometimes even a year. So these are our longer term alerts for options. And we're going to get into these details just a bit later. But if you want to have a sneak peek, simply go to tradingindicators.com/alerts. I'm going to put this link real quick into the chat box as well. And Jim, do you want to expand a little bit on this while I'm putting the link into the chat box? Let me just do it right here.
Basically, my opinion that's been created over decades now is that there are a lot of strategies out there, right? Now, there are strategies where you sell the options for small premiums and hope they go to zero. And people say it wins 80 or 90% of the time. But when they don't win, they can cost a lot more money than you ever took in. So that's a rough racket for most retail guys, especially working with smaller amounts. It's really not even up your alley. Second thing is when you have risk capital, you're going to be taking a chance with it. So how about a limited risk chance on both sides, meaning calls and puts at the same time, and then try to make sure the premiums you're paying are not that great. Make sure that there's news ahead that's going to move the thing, and make sure your expiration date encompasses that eventuality. That's basically what I do for work. I go out and believe me, they're not in every corner. It takes me a long time. People go, couldn't you just use some AI and find them? Well, no, because you have to find them that the price of the options are very reasonable. There is news ahead that's going to move it, and that you have an expiration date that is reasonable, that you're going to be around for it. Could be an earnings report, could be something else. But you also got to make sure you're not overpaying, because if the market doesn't move and you're going to have a loss on something, you obviously want to have as small a loss as possible. So I kind of specialize in options that are between 150 and 300 bucks. Sometimes I'll go up to 500 bucks once on Taiwan Semi. And maybe I'll go into the 400 on a Google or an Apple. But generally speaking, 80-20 rule, it's going to be in the lower end because I don't want to lose a lot of money on any one idea. And I'm very big on diversification. People always say, what's the best one? The best one. You know, I'm a very honest guy. I can't tell you with certainty what's the best one. So since I can't tell you with certainty, I can tell you what probably is the best way to go, and that's diversification. Now, here are some examples of some very big winners that we've had. Obviously, they don't all win. So obviously, you need to have diversification to hopefully get into some that do. Because you'll notice the regional bank, where we do a call at 61 and a put at 58 for 175 bucks. If you get a drop to 52, you had the right to sell at 58. So 58 minus 52 is $6 to the good. They call that in the money. That's going to be a $600 deal. But look at this one, Intel. Now, I did this before earnings came out. And so a $32 call, which I thought it was actually going to go up, and a 28 put came to 175 bucks. I think the put was only like 50 or 70 bucks. Now, I didn't know it was going to have bad earnings and drop to 19 in one day. But when it happens, that's how you make money. So that's why you, A, want to be diversified, and B, you want to position small.
Yeah.
You
And
don't want
Jim,
to
real
load
quick,
up anyone. Yeah.
real quick, just to reiterate, this is why we like these strangles so much, for two reasons mainly. First of all, they're typically short term. So, if things work out, you're going to see it very quickly. So they're not, short term expirations. And secondly, these are non-directional plays. So as long as the thing moves, you stand to profit from it. And if you combine this with a select pick, what Jim does, where you get a cheap price on the entire deal, in this case for Intel, only 175 for both legs of this strangle options play, together with an outlook where volatility may come in. I think that's a very valuable recipe for a potentially interesting setup. Sorry, Jim, I just had to say this. Continue.
Sure, sure. And, again, you'll get events that happen that are surprising to many, but they're going to be happy times to you. Look when these options expired on the ones from 728. We had that drop because of Japan unwinding the carry trade on August the 5th, and the whole market collapsed. Well, I think everybody looked at their accounting going, oh my God, I'm losing a lot of money here. And look at this, like on the Russell, a 233 call with a 217 put for 324 bucks. I didn't know it was going to go to 197, but I'm certainly going to take the money when it does. So the bottom line is that you don't know where the volatility is going to come from, so you try to diversify. Shopify was a different story. Shopify was an earnings play. They had good earnings, and the stock went from like 50 something to 75. So I didn't know it was going to have that kind of good earnings, but obviously I had done some study that it was going to have. The charts were telling me there's possible reversion to the mean, and so bottom line is that was a good move there. Cardinal Health, another earnings deal where they came out and knocked the cover off the ball. And Affirm, I don't know if you guys know Affirm, but when you go into fix your car and you only want an oil change for 60 bucks, and they tell you need a $1,500 part, and you're strapped for cash, these guys are in there and they're loaning you money to fix your car. And obviously they've charged a good interest rate. And with everyone working, people have the money to at least pay the interest. So I thought that because Upstart does the same thing and they had gone up. So I thought this would be a good deal. A little bit pricey for me, but again, we got a nice bang to the upside. I think the stock's at 47 now even. And so that was the story behind that. Best Buy was an earnings play. And, sometimes we'll do vertical spreads if we think, the price could go on a good run. And so, we did that with NVIDIA when it dropped down to 90 bucks from 140. Obviously, we thought it might bounce back. 104, 114 call spread looked pretty good to us. So I put that out as an idea. Now,
And we're
as a
gonna
trader,
just real quick, Jim, we're gonna cover the essence of strangle setups and vertical spreads towards the end of this webinar. So please stay tuned for this as well. Go ahead.
Okay. Yeah. And again, there's a lot of strategies out there. I know them all, butterfly this, iron condor that, behind the back pass, whatever. Hey, I want something that is clear, understandable, identify the risk, get into something where you think the potential is quite good, that's not limited. Now on the spread, it's limited because you got a spread on. I'm talking about the strangles here, where, it can run as far as it goes. And what I'm hopeful for, and we've had this kind of happen, is if you diversify and something doesn't work, if one doesn't work for 200 or 150 or 250 bucks, but you have another one that goes up dramatically, then I think on a long-term basis, it should be a pretty reasonable thing to do. At least that's my belief system. Only time will tell. I can't tell you what the future is, but I can tell you that being diversified has been the way to go. And also how to come out of them. I don't know when we were going to talk about the exit.
Definitely, and we actually got some questions on the exits in the Q&A, and we're going to cover these just a bit. So please hold on this one as well. All right, and here's another table with some of the highlights which were more recently. So these were alerts that we put out in September with expirations in October or a bit later. And yeah, as you can see here, some interesting and nice setups like Las Vegas Sands being a very nice play where we paid $250 for the strangle, and price jumped up. I guess this has also to do with China jumping up. We're able to sell the call for $1,000, giving us a profit of $750.
And you can get out anytime along the way. This is the maximum they hit during the period. Obviously, when 250 became 500 or 750, it's not illegal to take the money at that point either.
Exactly. This ties in very nicely as to when to get or consider an exit. Because as Jim mentioned before.
And there's your Pan America Silver, by the way. That doesn't even expire until next Friday, and it's almost at 25 bucks a share. So obviously that $400 is now looking more like $600 because 25 minus 19 is 6. It's a shade under 25, but it's a heck of a lot more than 400. You can almost put another 50% gain on the darn thing, and it's still got a week to go. And it like the silver price, it's benefiting obviously from people putting it into metals.
Yeah, exactly.
And there's your gold field. There's the gold field I was mentioning too.
Great. All right. So yeah, if this sounds interesting, let me share with you real quick of what we are putting out on a day or week-to-week basis, which is our options alerts email that we send out. It looks a little bit like this. You get the email directly to your inbox every Sunday, typically on Sunday afternoon. And it really consists of several parts, starting with an introduction of what has happened in the market in the last week. And we conclude this one with an outlook of what we think will happen with the markets moving into the next week. So you get a lot of context there. But of course, and let me just open this up real quick. This is also, you get a PDF which you can download and print out if you like. So this was one request that we got from our users. They want to print out the alerts letter, which is not so easy from an email directly, but this is why we have also added a PDF download option to our alert service. And this is an example from the alerts that we sent out on September 8th, which is a Sunday, if you look it up, starting off with the introduction of what has happened in the market and then jumping right into our options ideas. And level 1 is our short-term strangles. And as you can see here, for each alert that we put out, you see exactly what is the underlying symbol. So for example, FCX, Freeport McMoran, it's a strangle idea. When is the expiration? And what are, of course, your strike prices? We're going to cover this in just a bit, but a strangle always consists of going long a call option and going long a put option with the same expiration date. Okay, we list what is the approximate cost for the entire strangle, which is for buying your call and buying your put option. And back in the day, we had also a rating, our confidence rating of this. We have since, and this comes back directly from user feedback, we have since updated this format and replaced the rating with the sector this options idea plays in. And here the key idea is diversification, because this is really where the rubber hits the road. You don't want to put all your eggs into one basket. You want to diversify. And Jim, would you like to expand on the idea of diversification? Because I think this is a question that came up a lot. Because obviously there are a lot of alerts here. You cannot trade them all. So when it comes to deciding which ones to pick, because there's a lot of personal preference in there, but diversification should absolutely play a role as well.
Yeah, because these are ideas. We're not telling anybody exactly what to do here. These are ideas, and people can adjust these ideas, or they can take the strikes and see if they work for you, or you could obviously abstain from some ideas. So the idea is that you see in the beginning, let's start from the top just to get an idea here. You'll see three metals there. So obviously I'm saying metals should be volatile. So that would be one you'd pick. You could have picked Alcoa. Alcoa ended up going way into the 40s, and obviously the 227 went into way over $1,000. You could have taken Freeport, like I said, it went from 41 to 53. There's the evidence of that. And then, of course, you go down the ladder here, you see the banks. You could have done something with the banks. So now you got two sectors going, metals and financials. On the metals, you could also thrown in some Pan America silver for 190 bucks. And then if you keep going, you see energy. So obviously, we were thinking the volatility might be reasonable in the energy sector. So you can pick one of those. And now you're up to like 4 sectors. You keep going down, and you'll see, and of course, Cleveland Cliffs has done quite well too, I think, and they got earnings coming out. But Bristol Myers is a pharmacy, right? Pharmaceutical. And so bottom line, that could be another sector. And you could have thrown in uranium, because now that you know about it, because that stock's way into the 50s now. So that's been a good deal. And then finally, again, some of them don't move that much. So that's why you got to be careful. These utility ones did not give you volatility. And so that's an example of when they don't move. Now, when they don't move doesn't mean, you have to let everything go to zero. After 2 weeks, and like if you have a 4-week option, and after 2 weeks, or whatever option you have, after 50% of the time that you got on the clock goes away, it's time to reassess. And when you reassess, you can decide to either bail on the whole idea, change your strike prices or expiration dates, or grit your teeth and go, you know what, I'm going to let it ride for the next 2 weeks. So that I know the most I'll ever lose is $249 on that idea. And so I'm willing to risk the next 2 weeks and see if it happens. So, but at the 50-yard line, when half the duration is gone, that's the time to give it a go and give it an idea if you should be making any changes or abandon it or whatever you want to do.
Perfect. And just to expand real quick on the diversification idea, so the ratings column has been replaced by the sector, so that you can see right off the bat in which sector does this particular stock belong to. And then it makes this mixed diversification on a sector basis very simple. And this was the main reason why we replaced the rating with the sector, because we thought it is more valuable.
The stock, right? Yeah.
Yeah, exactly. All right. So this is level 1, but let me go further, because there are lots of strangle ideas. The level 2 actually have been now replaced with our outlooks on the indexes and also the micro and mini futures. So on level 2, he has been merged into level 3. So in level 3, we have our long-term plays. And these are ideas with expirations much further out. And Jim, what are these ones all about? Maybe,
well, of course, when the markets were down, we thought NVIDIA would come back. And so it has come back. And so the 110, 130 call, that means you have the right to buy NVIDIA for $110 a share. Simultaneously, you're saying you're obligated to sell it at 130. So you have to put up the difference, because if you're buying something, you pay money. And when you sell something, you receive money. So by buying the 110 and selling the 130, the differential was 625 bucks. Now, that's the most you could ever lose. And how would you lose that money? NVIDIA stays under 110, the time runs out, and obviously the option goes to zero. Okay? That's how you lose the money on this. How do you make money? NVIDIA goes to 130 or better. And as the time runs out, the spread can go to 2,000. but that's not going to go to 2000 until more time comes off the clock, or NVIDIA goes to like 170 or something like that. But the maximum gain is the difference between the two different strikes there. So what's the difference? 110 and 130 is $20. So that's the maximum the spread can get to. So $20 times how many shares? Every option is 100 shares. So a $20 maximum there times the 100 shares means the spread could go to $2,000. Now, $2,000 and backing out your cost of $625 means you could make up to $1,375 as long as NVIDIA can maintain above 130. And that's, either going to be if it goes deep in the money or at expiration. Now, the other thing is if it goes up to 140 like it is now, I would imagine the 625 is worth more than 625, so you can always sell out early. But if you want to hold on to it because you think that it will maintain strength and it will be above 130, well, you got over a 200% gain there, 300% gain, 6 turning into 20. Yeah, so that's exactly. Basically, and of course, why did we think it was a good idea? Because this company obviously has all the chips that people want. The Blackwell chip demand is insane, according to Mr. Jensen. So obviously, for people who wanted to play that game, this was the thing for them. Supermicro, this was done before the split. So obviously, they adjust the strikes for the split. But this is another one that, they do have solutions for the storage of the chips, and they have other support stuff. They're pretty connected to NVIDIA. And so some people think there's a lot of potential to it. So there obviously was a way to play that game as well. Yeah, if I could share the screen for 1 second, I would love to show them other ones in the other weeks and months that have been put on there, because I'm very proud of some of the things we've been able to do. So is there any way I could share for a second? And
go for it. Yeah, please go ahead.
Let me.
And I do see some questions coming in. We're going to cover these. Yeah, please stay tuned.
I want people to get all the value for the subscription. I don't want them to get, you're paying for a subscription. Use as much as you can of it. You'll hear ideas about all the different markets. If you hear something you like when I bring up China in the text, start looking at that. Or if I say if Bitcoin gets to this, you got to, So let me show you some of the things we have been doing here with the long term. I'll share it with you now here.
And Jim, keep it maybe to like 2-3 minutes that I'm gonna want to share with users.
I just want to show them 5 different things, so they get the idea here.
Go ahead.
Okay, we didn't share here? So we share? Yeah, I just want to make everyone understand what they get. And this is a value. So people who haven't been using this, I think they missed the boat. They should have been using some of this to go along with the strangles. Okay, Palantir, can you see me now?
Yes.
Okay, so you can see Palantir was, I've been very bullish on it. In fact, I own it for a long time. And then when it came here above that 30 number, I said, well, it's making another new high here. It probably is going to accelerate to the upside. So we had a December. This was obviously a month or so ago. The $31 calls for 475 going in there. They don't expire until December 20. Obviously, they're in the money now by as much as what? 44 minus 31 is $1,300. So, you would have bought it and left it alone, and you're riding it. Now, obviously, with it up here, you want to be grabbing some gains or adjusting your position. So that's one that I see long-term potential on. So that's why I suggest it. And then, of course, on this Bitcoin stuff, people were saying it's going to go way up. Tom Lee saying it's going to 100,000. Well, how can my subscribers possibly take advantage of it? And I think the Cadillac of this, if you're bullish on Bitcoin, is MicroStrategy. And we're very fortunate to put this in the alert. I'm very happy we did, because this was I made it very clear. This is, if you want Bitcoin, this is the way you can work it. Because what these guys do is they issue bonds, and then when you loan them money, they buy Bitcoin with the money that you've loaned them. So you can't get any more committed to Bitcoin than these guys, this Mr. Sales gentleman. And it's a volatile deal. But if you buy it against the stuff here, that's the time to do it, not up here. Okay, this is called growing. So, down here we looked at a 140 call and a let me see here. It was a 140 call, 145 call, and a 195 call spread. So we bought the 145 and sold the 195 here, and the differential was about $1,600. And we were trying to turn $1,600 into $5,000 if it could get to 195 or better. Well, obviously it's at 215, and it's going well. The other one we got for the people who think that I thought this was going to play catch up, Coinbase, because it looks like everyone's getting into the thing, and Coin's going to be involved, right? So it was up almost 10% or 8% on Friday, and you can see here, we took a shot at it down here on a longer term position, and it looks to me like it's ready to go on a ride. So again, there's a couple of examples there. We have Alibaba, we have Cameco, and others as well. But that was a good example of why the long-term ideas, may be something to keep an eye on and incorporate into your trading.
Thanks, Jim. I was muted. Let me quickly go back to my slides because next I would like to share with you guys how you can get hold of our alert service. And we actually have a super, super special right now. And then we're going to talk about all the questions that came in. And we also are going to talk about the strangles and vertical spreads. So I'm going to give you a bit of education on that one. So I'm going to grab the screen back real quick. There we go. Okay. So we have put together a very special deal. And remember, early on today, I mentioned that you can get hold of our options masterclass completely for free today. Normally a $397 value. Today, you can get it completely free. And you can get it by signing up either for the monthly or the quarterly option. The quarterly option is something that we just added as a brand new thing. But either of those options will get you a free copy of the options masterclass. So normally at $397, but it doesn't stop there. You will also get a 50% discount for your first term. So if you sign up for the monthly option, which is normally at $197, you will get the monthly option for only $97. If you sign up for the quarterly, you will also get a 50% discount on that. So this is something that we offer as a special for you. And once again, the link is at tradingindicators.com/alerts. But there's one more thing, and this I think makes it really, really special. It gets even better. If you decide to sign up for the quarterly option, and this is really something that we do on an exceptional basis with the objective of giving you all the tools that you need to be a successful options trader. So we're going to add to the quarterly option a 1-hour personal coaching session by Coach Jim, the option professor. And this is really something really special. It's for a limited time and available if you use the quarterly option. So you not only will get the free masterclass, that's of course included, you will also get the 1 hour of personal coaching. So here's a summary of these two options, once again available at tradingindicators.com/alerts. So either the monthly, normally at $197, but for the first month, you only pay $97, which includes our free 6-hour options masterclass, or you sign up for the quarterly, normally at $397, but you will get the first month for $297 only. You will get the 6-hour options masterclass and 1 hour of personal coaching by the option professor. All right. So I think this is an amazing deal. And for those of you, and I've seen some questions coming in, who are wondering, oh, I'm currently on the monthly, how can I get the quarterly option? There is, just drop me a note. I'm going to give you my contact information in just a second. Drop me a note and we can switch you over to the quarterly option. And that way you can also take advantage of the coaching special that we have going on for the quarterly. And Jim, would you like to expand perhaps a little bit on these two options, why we are, adding the coaching to it?
Well, I'll tell you one reason I love working with trading indicators is there's a community here, and it's a community that I feel is trying to help people. And so having worked in this thing for so long and seeing so many people trading options, getting so much information from so many crazy sources, I am very much feeling good about helping traders reach their potential. And so I think there's three things that traders really need. The first thing they got to get smarter, right? They got to get more knowledgeable. And so that's why we give you the master class. I mean, for God's sakes, it's 3 sessions, 6 hours. It's going to be very comprehensive. So you're going to be smarter when you come out of it. So that's number one. You need to get smarter, right? And again, I've been trading them for decades. So the likelihood I know more about trading options than the average bear, I hope, is pretty high. So, and again, I know how to explain them because I've been explaining them for decades. So that's number one, education. Second thing you need is you need some ideas, right? And so I know my job. I've got to go find good ideas because that's the only reason people will hang around. And I think I'm doing an okay job, if not a lot better than that, doing that. So you'll have ideas to take a look at. So you got your education, you got your ideas. Now, what's the last stool? The last leg on the stool. You need to talk to somebody sometimes, right? And so you can reach me, and I want you to reach me if you're having any problems with this stuff. And it could range from, well, the price of the options moves. What's my choices if the prices moved? Well, I'll discuss what your choices are. They're pretty common sense choices, but sometimes you need to be, explained it, right? Or it could be, how do you really diversify here? And how does that work? I'm a little unsure about diversification. Or it could be, I get in these things and I don't really know how the heck to get out of them. Well, there's some pretty cut and dried, methods of coming out of them that don't involve just abject guessing. And so, risk adjustment and then positioning. Don't trade like a maniac. You're not going to be around very long if you are. You can see how the potential of these things if they move. So you don't have to have 9 million positions, and that'll make your bankroll, your risk capital, last a lot longer in case we go through a lack of volatility phase, which has not been a problem that much, but you can see. So there you go. You got your education. You got your what? You got your ideas. You got your what? You got a guy you can email and say, listen, can I talk to you for a minute about a couple of things? Sure, I want you to do that. Otherwise, you're in the dark, and you won't get the most out of the subscription. And then the last thing is starting out at $97. I mean, for God's sakes, it's a month-to-month situation, and at $97, I mean, you're going to get a master class. You're going to get a month worth of ideas. You're going to be able to email me if you have questions. That's an awful lot of value for less than $100.
Perfect.
I mean,
and Jim, let me answer some questions because we're getting lots of good questions from everyone. So let me start with Frank. Frank from Den Haag. Frank has been with us for a long time. Hi, Frank. How are you? And he's wondering, is there any contract with these subscriptions, or can I cancel after 1 month or 1 quarter? And Frank, be assured there's no contract whatsoever. It's completely up to you as for how long you want to stay on. We hope, of course, that you will stay on. We're gonna give you all the tools for you to become a long-term customer, but of course you can cancel at any time. There's no contract, so don't worry about this. Secondly, from JP, and this is my uh, I made a small mistake early on. So for the quarterly option, actually, it's not a 50% discount for the first month. It's $100 discount. So this was an old slide that we had when we only had the monthly option. I apologize for this. So for the quarterly, the first month is at $297. So I'm sorry for this confusion early on. All right. Somebody wants to know, yeah, okay, but we're gonna cover, we're gonna discuss why we prefer debit spreads over credit spreads, and maybe we sometimes even do credit spreads. This is gonna come later on. Oh boy, lots of questions here.
well, I can give you a quick answer on that.
Okay.
Again, we're trying to make a large amount of money with a small amount of money. That's never going to happen with credit spreads. And you're going to wake up every day wondering if something big happens. I did a 10-point spread and I got $1 or two. And you're going to wake up every morning fearing that if the market makes a huge move, you're going to have a $10 minus $2, or you're going to have an 8-point loss, or maybe a 6-point loss, or a 7-point loss. And again, if you're taking in 25 cents and you're losing $1 or 3, If you do get whacked, it's going to draw your equity down and maybe cause it to go down a lot. And then you're going to try to make the money back with this relatively small cash flow. I'm very familiar with the strategy. And again, I've used the strategy, but I think most people out there who have risk capital and want to risk a relatively small amount of money to make a lot, I think this is obviously a better approach than trying to, and they even call it picking up quarters in front of a freight train.
Awesome. Yeah. And Frank just said he's in. Perfect. Hey, Frank, welcome on board. I knew you would be. Frank and I, we go back many, many months or even years now. Perfect. Okay. So let me, and there's so many good questions, so don't worry, I'm gonna get through all of these. And this is actually a perfect time. So, okay, so we answered the credit spread question. Doug wants to know if he has an options idea in mind, which is not part of the alerts. And of course, if you are a subscriber, is the option professor willing to discuss perhaps potentially an idea that a user found on its own? And I believe the answer, Jim, is absolutely yes.
Well,
So
like
as long
I
as
always tell people, when you're a customer of ours, you're a friend of ours. And if a friend called you up with a question, would you hang up on them? So obviously, but again, none of this is where I give advice. None of this is where I tell you what to do because that is outside the parameters of what we do. But am I allowed to give an opinion? Am I allowed to voice an observation? Of course I am, and of course you could take my input as an opinion.
yeah, perfect. All right, so let me go through some other questions real quick. We had Frank. Yeah, Doug wants to know, and this is from Doug Dixon. He wants to know whether the options masterclass is archived. Yes, of course. So if you cannot, you we're gonna send you the recordings of the masterclass. It's already all recorded. We spent the summer doing this, and Doug, you will get the recordings, and uh, these recordings are yours to keep forever. So you can download them to your computer, to your iPad, wherever. Keep them there forever. These are yours to keep. And you get them if you either sign up for the monthly or the quarterly option. Absolutely.
Daniel, a good example of the last meeting we had when the trader asked me, "What do you think of silver?" Now, I didn't go tell him to go buy all the silver he can buy, but I did tell him it looks like it's going to spike to the upside. And of course, he could have taken that information and done whatever he wanted to do. And so, in that case, the information was quite valuable.
Absolutely. Perfect. I'm just gonna go real quick through some questions here. Let's try to keep track a little bit. Yes. Okay. So Dilpa wants to know, and this is a very good comment, and I don't think I even put it on the slides here. There's actually another perk which you will get. It's optional for you if you want to take advantage of this, but there's another perk which you will get when you sign up for our options alert service. You will get a 50% discount for our Liquidity View dashboard. And this applies for any options that we currently offer for the subscription. So yes, and what you need to do to take advantage of this is to simply drop me a note, say, Daniel, I'm also interested in Liquidity View, and I'll make it happen. So yes, that's absolutely true. And I was so excited about these bonuses that I forgot about the special pricing for our Liquidity View dashboard. Perfect. All right. So this is good. And Jim, I think before we proceed, actually, this is requested too. Let's move over to the last part of this webinar, and then it's going to be more time later on for Q&A. So what we specialize in mostly with our options alerts are ideas which have the potential to grow a small amount, low risk, into potentially a big amount. There are two strategies, which there are others as well, but there are at least two strategies when it comes to options, which have these high reward and low risk ratio. And these two strategies are either strangles or vertical spreads when it comes to options. And just to give you an intuition, if you want to see all the details, you watch the options masterclass. But just to give you an intuition of what these two strategies are all about, because they're quite different. Let's start with strangles. So a strangle is what we call a non-directional play. In a non-directional play, you will benefit whenever the stock, the underlying, is moving. It can be to the upside or it can be to the downside. If there is a significant move, you will benefit. So, for example, earnings may come up in a week from now, and your anticipation is, hey, these earnings will shake the stock price. This could be a good idea for a strangle, provided that the cost for the strangle is relatively low. Of course, this is where the option professor and the options alert are specializing in, because it's not just about forecasting volatility. You also need to get a good deal for the strangle. There's always two things to the equation. So whenever the price moves, you think the price will move and you get a good deal, you would buy a call option and a put option with the same expiration date, but at different strike prices, both being out of the money, but same expiration date. This is all what you're ever gonna risk for a strangles, the cost for the call and the put. And you will benefit if the asset, meaning the underlying stock, will move significantly if there's upcoming volatility. Okay, so that's the strangle. It's non-directional. A vertical spread is a directional play. Here you are betting on a direction. Say the stock will move up or the stock will move down. You are committed to a direction. But we also want to limit our risk. So what we're going to do is we're actually going to buy a call option and sell a put option. And since we're selling a put option, we're going to get some credit for this, which we can use to offset the cost of buying the call option. This is exactly what a vertical spread, a debit spread, is all about. Now, we have limited risk. It's going to get relatively cheap to buy this, but of course, we also have, always comes with a downside. We also have limited reward, but sometimes it's worthwhile, and we're carefully picking these vertical spreads so that you still get a good deal for your buck, and oftentimes the potential reward outweighs the risk, the cost by a multiple. And Jim, would you like to expand perhaps real quick on why we are liking vertical spreads?
Well, again, you're trying to reduce your risk. And how do you reduce your risk? Well, you're buying an option that's going to cost a certain amount of money. So you're going to sell another option to get some of your money back. And so if an option costs $10 and you can sell another option for $7, your risk was just reduced by 70%. That's not a bad deal. Now, you don't get something for nothing in this world. You are giving upside potential above the top strike price. So if it's a 10-point spread, a $10 differential in the strikes, $10 difference, that means the most you could ever make is $10 on the spread, minus your $3 you paid in that example. That's still tripling of your money, but it's not as much as if it goes up $50 like MicroStrategy's going or something like that, right? But they don't all do that, so you can't plan on that. What you can plan on is reducing your risk so you can stay in the game as long as possible. So one idea does not cost you very much money, which is really the concept we're working with here. We don't want any one idea to cost us a lot of money so that our bankroll, our capital use will last until we do get the volatility. Some months they seem like all the strangles are moving, and there'll be months where some do not. So that's where the diversification comes in, and the fact that your positioning is not crazily aggressive. You're doing smaller positioning, letting the market make you money rather than trying to force the market to make you money by loading up on something only to find out that it didn't happen. So yeah, the verticals are basically a way to get that cash risk down while still putting yourself in a good position to win.
Perfect. And we just had a question on the directional spreads, on the vertical spreads. Yes, your profit is capped. It's basically the difference between the spread between the strike prices and what you've paid for the vertical spread. So how do you determine the size of your spread? Well, this is where the options idea comes in, because we're going to tell you what the size of the spread is. And this, of course, has to do with what our outlook is of where the stock price may move next.
Yeah, obviously, where you think the price might be going will dictate the strike prices. And then, of course, trying to keep the risk reward at an attractive level. So obviously, there's some things to consider when you're coming up with an idea.
Perfect. And Jim, maybe you can take back your the slides again and show we have some symbol requests if you have time
Yeah, I'd
to
like
look
to
at them.
also show you the recipe on how I come up with an idea here so people
Perfect.
can see that. So when I share, I've got Pan America Silver up there.
And you have to reshare.
Yeah, sure.
Yeah.
Just got to hit the share button there. Where are you, share? There you go. Share, share, and share alike. I'm hitting, and then I'm hitting, and then I'm sharing.
It's coming up.
Yeah, because I think,
We can see it.
knowing where I'm kind of originating the ideas would give you confidence that I'm just not obviously, doing anything. You know what I mean? Yeah, I have to be particular on what I choose because, again, I have to provide you with good information if you're going to stay. So obviously, I know my job. Well, I'd rather not do an idea than do one I'm iffy about. So I have the Pan America Silver up there.
Yes, we can
Okay,
see it.
so you could see it ran up to $25 in Q2, and then it had a nice big pullback to my blue line. Now I think if I measured the rally from the 12 up to 24, I bet you the pullback was pretty much a 50 or 61% pullback. So you had the Fibonacci thing coming in, but more important, that blue line was rising. And this is an uptrend. So when you get an uptrend and you get a pullback, you gotta shoot the gun, right? So the bottom line is when we're at $18, that's when I did the 19 call and whatever it was, 18 or 17 put for $1.97, $1.97. And again, obviously the thing has done what I hoped it would do, which is take off. And it's still got another week to go on this idea. So I don't know where it's going to go, but it certainly looks like it could start really exploding to the upside. And if it does that, it's going to be a home run derby. But that's the original. See, I get into this stuff when
Oh,
it's
Jim, we lost you there for a second. Are you still there?
yeah. Can you hear me?
Yeah, I think you were muted for a second. Okay, we can hear you again. Good.
Okay. So anyway, again, my idea is I wait for the reversion. That's when the calls will be cheap. And then if the trend is up, I'm assuming the reversion is just that, a reversion that will end. And I'm also aware of seasonality. The end of the calendar year and the beginning of the new year is when these metals can go nuts. And as you can see, they're already doing that. So there was a bunch of things that went into the soup. But the basic thing is it reverted to the mean. The options were cheap. I'm bullish on the sector. So if I was ever going to put a position on or give you an idea, this would be the place to do it. And that's why the idea worked out so well, because the timing is key. Now, you had some questions on other stocks these guys wanted to talk about, or?
I'm just was answering one question. Okay, perfect. Yeah, somebody wants to know, can you open up symbol ACAM, AKAM? Not sure if you're
Isn't that
familiar.
Akamai? Yeah,
Akama. Yeah,
Akamai,
there we
yeah.
go. What's your take on this? And this is yeah.
I don't know when they have earnings coming out, so I'd want to know that for sure. And then I'd look at the charts. Because, when these guys announce earnings, all heck can break loose. Now, obviously, it looks very good. Let's look at the longest term chart I got, see if there's anything there. Yeah, okay, so that looking good. Obviously the time to do it was when it pulled back. It ran up to 100 and change. When it came back here to 92, that's when I would have hit it. And of course, when it went here and it had the traffic jam right at 95, that's when I would have hit it. And now I'd be, at the beach enjoying myself, watching my money grow. But, if you haven't done that yet, then obviously, you'd want to know right this second what to do. Well, I don't know that I'd initiate a position because the options must be very high now. And I'm not in the business of buying high options. I'm in the business of buying low options. So it wouldn't be my cup of tea to get started here because I'm sure you'd have to pay through the nose for a call now. But you
Yeah.
wouldn't have had to do it at 92 and you wouldn't have had to do it at 95. So does it look good? Of course it looks good. Does it look like it can keep going? Of course it does. And where would I probably expect it to go? I would measure from 130 down to the low, which is around $87. So let's do this. 130 minus $87. 130 minus $87 gives me $43 times 61%. Rough math is around 26, $27. And so I would look for well, actually, it's just made a Fibonacci rally.
Yeah.
the rally would have taken you towards 114. Yeah. So 114 would be a neighborhood where it might be going to, and it would be a neighborhood I'd be watching to see if it can sustain itself, because that blue line pointing straight down is not bullish. Okay. So again, I would watch. And is there anything else that would tell me 114? Yeah, not really. But I would watch, if it, obviously it's got great momentum. If it got up to 114, I'd start watching it to see if it's going to have some trouble. Because again, that's a Fibonacci thing. Now, how far could it go? You see a gap up there? Okay, that's an attractor. So that'd be 122, 124. So, this thing has momentum right now. It's got a Fibonacci retracement towards 114 as a possibility. And it's got a filling of the gap to 122 and then maybe another gap up there, 128. So it's got all kinds of potential. Again, I don't know when they're coming out with earnings, but if they come out with the kind of earnings that Netflix did, then obviously it could have an acceleration to the upside. And let's look at your RSI right here. It's at 70, so it's already past the 65 number. So an acceleration phase here would not surprise me at all. It's just that I don't like to get into a party when everyone is already there and the band is already into their fifth song. It's just not my setup. But that's how I basically feel about it.
Awesome. Thanks, Jim. And one more symbol that came in. What about AT&T? Ticker symbol T.
Okay. On AT&T, we go to the longer term chart and we see, now that's a little bit more interesting to me because it's closer to sea level, but you're going to run into something right here, it looks like. So, you've got clouds above at around 23, 24 bucks, and it's already at 22. So I'd be a little concerned about that. Not to mention, in fact, it's already gone from 14 to 21. So obviously, where should you have been buying? At 16 and then at 18. If you had done that, all you're worrying about is where to take your profit. See, coming into games that have already happened is more risk than I'm interested in, because I don't want to lose money. And the way you can lose money is you buy things that have already happened, you pay a high premium, and then they stop happening. And then you look in the mirror and you go, you know what I just did? I provided liquidity for the smart people who bought at 16 and 18. And now I wish I hadn't done that, because I don't have so much money to be so generous to the smart guys. So let's go and further look and see if there's anything else. Again, on the shorter term graphs, it has all kind of potential. Right now, I definitely want it to stay above the red line at 2075. So if I did get into this thing, say, Jim, you must trade it, I would say, okay, I'll trade it, but I'm going to keep it on a short leash. And where's your leash? 2075. That's about as far as I'd give it on the 1 year. Yeah, you see 2175, 2150. Okay, with this thing, maybe I'd give it 2150. But I'll tell you one thing. If it starts breaking under 2150 and 2125, they will be saying timber to this thing. So be careful up here, because again, these things are meeting. So it's a very exciting time. When these averages meet, volatility follows. Now with the blue line rising, the bet would be it's going to break to the upside. Okay. So, if you're in this thing, you're doing good. I think the 2075 or even 2125 would be as far as you'd want to give it. And then, of course, if it takes out this high, it's got some upside potential. But again, it does have some longer term stuff that it might have to deal with at the 2350 level. So that gives you a little bit of an idea on that.
Thanks, Jim. And I think there's another question which we should address. It's about exits. And what is your take on exits? Because I remember, maybe I get this quote right, but we are not in the game of what is it? Run and sit and run? No, see it again, Joe.
We are in since we're dealing with 1 month options and things like that, we are in a hit and run business, not a hit and sit.
Okay, that was it. Okay.
So
I think that's a great analogy. And maybe expand a little bit on that, on when somebody should consider an exit out of an options trade.
Yeah. Well, there's 3 basic ones that I think are good, but there's 9 million out there. So, do whatever you like. But my idea is, after 50% of the duration of the option comes off the clock, you do a reassessment, which means if you had a 1 month option, after 2 weeks, you go take a look at it. And you say to yourself, okay, this thing doesn't look like it's ever going to happen. And there's no news ahead that I know of, like no earnings report that's going to make it move. So I might abandon this thing and use my rest of my money for something else. Or I still think it's going to happen, but I only got 2 weeks left. This might be the time to add a little bit of money and move them out in time another week or so. Or maybe the strike price could be changed a little bit. That would be another choice. And then the final choice is to grit your teeth, knowing fully well that you've got a limited amount of risk on it. So you can't lose any more than the value of the option. And you believe that in the last 2 weeks, something big might happen. So you don't mind taking the additional risk. So sitting tight and seeing what happens is the third choice. So it's 50% of the time goes by, you do your reassessment. And then if the market pops, grabbing the money like in China was a good idea, because again, we're in the business of trying to grab profits and then go find another idea. Or thirdly, if you get a stock like IBM, which has been trending like a little ever ready battery, you would take a short-term chart and a short-term moving average, maybe 5-day, maybe 1 month, whatever you want to do, and try to follow the trend as long as possible to make as much money on it as possible. The risk there is a Tesla comes out and drops 10% in a day and your profit goes out the window. So following that trend is nice, but every day you're in there with the time running out, if it has an adverse move, you could go from champagne to very bad wine in a day. So I'm big on grabbing the profits, and then if anything, readjusting your strike prices, meaning roll them up. That's why I say when you get these, when you're a subscriber, you're a friend. And if you have a question on either diversification, position sizing, entry, how to entry, or the price have moved on you, or coming out of these things, again reminding you of the different choices, you can email me and I'd be more than happy to try to help you. Again, I'll just give you my opinion and then you can do with my opinion as you wish.
And John, now, or Jim, sorry, now for the very luxurious situation, let's say you are in profit, your strangle, let's say, is up by a certain amount. What is your take on it? Should we ring the register quickly or maybe let it ride? Or what is there a sweet spot that you may want to consider? That's another
Well,
question
a lot of it has to do with your comfort level. If you're fairly new to options and moving your positions around is a very difficult thing to do, you just grab the money, you bank the money, and then you're looking for a new idea. That's the simplest thing to do. Bank the money and look for something else. Where the setup hasn't already happened, right? There's 5,000 stocks out there. I'm sure we can find some others. So that's one. The other, if you're an experienced trader like myself, you might roll your position up, which means you're going to sell the one strike price. Like I'll give you, for instance, on the FXI China. I had the 26 strike price. It jumps up to 37. For whatever reason, I want to keep going. So I get out of my 26 call and I move it up to the 38 call. And rather than having a week to go on the option, I buy another 2 weeks. So I'm grabbing profit and I'm reinvesting the profit into the direction that it's going. Or I roll the whole position up, which means what? The stock was at 26 and I had a $26 call and a $25 put. And now it's up at 37. So I take the profit on that call of 11 bucks and I go up to the 40 call and the 35 put and put in some of my profit back in. And then when it just dropped back down to 30, I could have made a hit on the drop. So there's a number of things you can do. And of course, that's where the coaching comes in, guys. I mean, 90 days goes by very fast. So, I think it makes a lot of sense to do the quarterly and to get that coaching situation so we can iron out a lot of these questions. It's going to make your learning curve a lot shorter and it's going to have you avoid a lot of dumb mistakes. So, you should really consider the quarterly thing because that'll give you time to use the information and it'll also give you that free. That's 200 bucks in your pocket. That's what it costs to get an hour session. So, that's a lot of value there. So, personally, I think the quarterly deal, that's why I mentioned it to Daniel. I go, Daniel, people really do need the coaching, but I'm not going to just give all my time away for free. So, why not get the quarterly deal for $297? You're going to get $200. Get this deal. You put up the $297, you're getting a $397 course. And you're getting a $200 of coaching. So you're getting $597 worth of stuff. That's like 600 bucks worth of stuff for $297. And now you got 90 days. And you got 90 days to work with it,
Exactly. Yeah, I think it's a terrific option, and thanks, Jim, for making your time available for this specialty that we have put out there. And I'm sharing my screen again, so guys, um, as you can see here are, as you can see on the slide, here are your options. So either you go monthly, which includes the 6-hour options masterclass, the first month at 97. Or you're going to go with the quarterly option. The first quarter for 297, you get the masterclass and you get 1 hour of coaching directly by the option professor. So I think both are terrific deals. Go to tradingindicators.com/alerts if you want to learn more, and if you want to take advantage of any of these options. And I know
And
many
one
of you,
last thing,
guys.
Daniel, on
Yeah,
the 1 hour, I don't use a stopwatch on people. Like I told you, when you're a customer, you're a friend. So I'm going to try to make sure you get pretty up and running with your education by the time we hang up the phone.
that's awesome. Yeah, thanks, Jim. Yeah, I think it's awesome. So we're very dedicated to our users. As Jim mentioned, we are one community. We work with each other, and your success is our success, and vice versa. So we see each other as one team, and nothing would make us happier than welcoming you on our team. All right, guys. So that's it. Let me quickly see if there are some other questions coming in, some last minute questions. Doug wants to know, yeah, and again, this is a personal preference, Doug. How do you establish a grab the money and run profit target? Uh, and Jim uses his moving averages for this. So once they start turning, so if you're in a long play, for example, or your call is, in the money and things are moving averages are turning, that is a warning sign, a yellow flag or red flag to potentially look at selling your strangle, or at least selling one leg off your strangle, for example. And you just use your basic technical analysis to time your exits. You keep things running as things look very bullish, for example. Once again, so your call is in the money. And if things are not looking so bullish anymore, well, then you reassess and potentially sell the call leg of your strangle, or perhaps close the entire position altogether.
And then, Daniel, mentally, you've got to accept the fact of life that you're not going to get the highest tick when you get out all the time. You have to understand that the game is booking gains and then going to find another setup where the risk reward parameters are back at the cheap level. So again, because we have a ticking clock called the expiration date, if you really love the thing, you still want to book your gain, but then you want to adjust your striking prices so that you're grabbing money off the table, and then you're just reinvesting a part of your profit. So if you're gung ho on staying with it, you've got to switch your strike prices up to current prices so that you can book a gain, walk away a winner, and then you still have a new position at the higher level.
Exactly. So I was just answering another question. Yeah, so I think that's a great strategy, because we're putting out so many ideas every week. We're not going to run out of ideas. So sometimes, just ringing the register, there's nothing wrong with it. It's a good idea. And then, you start from scratch again with a brand new idea where, as Jim said, the reward to risk ratio is reset back to like a very advantageous ratio. These are the ones that we are looking for. All right. Perfect. Great session, I have to say. So we are now 1 hour and 30 minutes in, longer than expected, but we got so many awesome questions. So if there is a question which we didn't cover, you can always reach out to us via our homepage, tradingindicators.com. Go to the main menu. There's a contact item there. Click on it, fill out the contact form, and your question will go straight to my inbox, and I will share it with the option professor if needed. And of course, you can also always reach the option professor directly for any questions at his email address, professor@tradingindicators.com. Let me quickly put this one into the chat as well. So it is professor@tradingindicators.com. Let me see if I didn't misspell it. It's not so easy to talk and type at the same time. I think I got it. There we go. So professor@tradingindicators.com. Perfect. Guys, so thank you so much. I'm going to look one more time at the questions that we have. Okay, just one quick look. And there's Doug. There seems to be Doug sent me an email about this. He says there's a confusion about the pricing on the page. Doug sent me a quick note. I will take this offline. So we're gonna walk this one out. Don't worry. Okay, perfect. All right, that's it. Jim, any last minute words, or can we?
I wanted to thank everybody for being here, and I'm
Yeah,
very hopeful that you guys do become subscribers and members, so that I can again do my best to help you develop into the best option trader you can be. And I think there's a lot of things there that are going to be very helpful to you. So I very much believe in what we do. And again, you have access to me through the email if any question comes up at any time. And of course, if you go for the quarterly deal, I'll make sure after our session that you're pretty up to speed on how this all works.
awesome, perfect. Yeah, so thank you also from my end for your time. I know your time is valuable. So spending this Saturday afternoon with us means the world. And yeah, thanks, guys. Enjoy your weekend, enjoy your Saturday, and hopefully see you all on Tuesday when we have our next lunch and learn session or at our any of our next upcoming webinars. Until then, guys, happy trading and yeah, stay safe. Bye bye.